taxation of employment income. We have looked at the groundwork, the foundational notes. So we have shared those notes, we have discussed them. In case you don't have the notes, I can as well forward. Group utaenda pale kwa reception required. Kama uko online, when you're buying these things, you're given the notes and then you add it to the group immediately. So I expect all the online students to be in the group. Our students here, you can pass by this admin office and then you'll be added to the group. So there is where we'll be sharing the notes, isn't it? So there we have the notes. Nani hana notes na hana past paper? Uko nazo? Soft copy, which is also good. Uko nazo? So now today we are going to look at questions. So I'm reading the question and then we do it. So the question reads, Alex Makali is an employee of Pengo Limited. During the year of income 2020, he provided the following information to you to assist in filing of individual income tax return. Number one, basic salary of 144,000 per month, net of payee or payee tax of 19,600. And number two, he was provided with a Land Cruiser whose accumulated depreciation as 1st January 2020 was 130,000, while the net book value was 1.6 million. Number three, he was provided with a fully furnished house. The cost of the furniture was 250,000. The house had a fixed telephone. The average telephone bill paid by the employer per month was 6,000. Number four, on 1st September 2020, he moved into his own house, which he had acquired through a 15 mortgage loan of 4 million on 1st May 2020. Number five, he's a member of House Ownership Saving Plan, where he had contributed 4,800 per month towards the scheme up to 30th April 2020. Number six, on 1st July 2020, he obtained a loan of 2.4 million from his employer at an interest rate of 7% per annum. During the period, the Revenue Authority prescribed interest rate was 12% per annum. Number seven, he was out of his workstation in the month of August for 10 days on official duties. The company paid him out-of-pocket allowance of 4,800 per day. Number eight, his salary was increased with effect from 1st September 2020 by 8,000 and backdated to 1st May 2020. Number nine, the employer paid school fees for Alex Makali's children amounting to 148,000 shillings. This expense was not taxed on the employer. Number 10, he is a member of the Registered Retirement Pension Scheme, where he contributed 30,000 shillings per month towards the scheme. The employer contributed a similar amount. And number 11, the other incomes included dividends from Wali Cooperative net of tax of 85,000 shillings, rent income of 280,000, net of purchase of furniture 40,000, and cost of advertising vacant houses for 24,000 shillings. And number 12, he secured a life insurance cover for his family of 8,000 shillings per month with effect from 1st October 2020 required. Total taxable income of Alex Makali for the year ended at 1st December 2020, 12 marks. And number two, the tax liability in bracket, if any, from the income computed in B1 above. Total marks 2. Total marks in cumulatively 14. So now they want us to compute So you're going to write the name of the person you're computing the taxable income for and the tax. So you write here Alex Makali. Alex Makali. Computation of taxable income, for the year of income 20, 20. And then you underline. Here you can write shillings and thousands. Or you can just write shillings. So we want, first of all, to list the benefits. And when you're listing the benefit, you list the benefit in accordance to the time the benefit was given. If the benefit was given for 2 months, you only record it for 2 months. So we are computing for the whole year. So we compute the benefits. Okay. So the first benefit there is basic salary of 144,600 per month. But this one is affected with note number 8, which says his salary was increased with effect from 1 September 2020. It was increased by 8,000, isn't it? And backdated from when? 1st May, isn't it? So meaning from 1st May, so his basic salary here, we're going to write your basic salary. We're going to write your basic salary. So the salary was 144,600. And then for 4 months, this one was for 4 months, isn't it? And then 144,600 plus 8,000. How much is that? 152. So plus 152,600. From May to December, how many months are those? Is it 8, 9? Eh? It is 8 months, isn't it? So his salary was 144,600 up to April, isn't it? Then from May to December, it was increased by 8,000, isn't it? So it now became 152,600. So the total salary for the whole year, it will be how much? Basic salary. Nakuja ngapi? $1,799, 200, like that. So that one will be the basic salary. The pay is advanced tax. I'll show you how to treat it. And then we go to note number 2. He was provided with a Land Cruiser whose accumulated depreciation as at 1st January 2020 was 130,000. The net book value was. So here we come here, we have the car benefit. So first of all, determine, was the car provided for the whole year? That is the first question you need to answer. He was provided with he was provided with a Land Cruiser. So it was given from 1st January, isn't it? So now when you said you're given a car by your employer, you compare the CC ratings of the car. The CC ratings of the car. So when you check the question papers that you have, the first page of the question paper, the latest one, you check, you'll see we have this page here, the first page of your question paper, which has some columns and some ratings there. Now for the Land Cruiser, you go down there, is the last item of the last column. Can you see it? It is Land Cruiser. So irrespective of the CC, so long as it's a Land Cruiser, you go Land Rover Land Cruiser. So the CC rating is how much? 86,400, isn't it? And then now you compare with 2% per month, which now becomes 24% per annum, 2% per month of the initial cost of the car. So 24%. Now the initial cost of the car, what is the initial cost? You have been given the net book value and the accumulated depreciation, isn't it? So you have been given the net book value. The net book value, we know it is the cost minus accumulated dip. So the net book value of the car is how much? The net book value is 1.6. The net book value is 1,600,000. The cost we don't know. And the accumulated depreciation is how much? 130. So this one goes to the other side. So for us to be able to know the cost. So 1.6 million plus 130,000. How much would that be? 1,930,000, isn't it? Is 630, 730, isn't it? So this one is here you use the original cost, not the net book value. Every time you're doing the comparison between the CC ratings and the initial cost, you don't use the net book value. This one is, we discussed this one. We said we have the notes. We said that is how we determine the 2%. We have it in the notes. We have how to determine the taxable benefit for vehicle. We had discussed this one in the first class, isn't it? So how much is that? 24% of 1730. 415,200, like that. Then here you pick the higher of the two. So for the car benefit, for the sake of those ones who are not here in the class, we said when you're given a car by your employer, for us to determine the amount that we are listing the gains you're getting from employment. So if you're given a car that is a gain to you as an employee, we want to know the amount of money that we're going to tax you for the car. So we take the CC rating, it means cubic centimeters. Then we compare with the 2% per month of the original cost. Or if the car was given for the whole year, 24%. Whichever is higher of the two, we are taxed on that. So we have 86 and 4. So you write here 415,200. So that is their taxable amount. We are through with the note number 2. We go to note number 3. He was provided with a fully furnished house. The cost of furniture was 250,000. The house had a fixed telephone. The average telephone bill paid by the employer per month was 6,000. So here we have 3 benefits. We have the house. He was given a house. Besides, the house was also furnished. That is second benefit. And it was also it had a telephone, which was being paid for by the employer. So every time you determine the taxable benefit for any benefit, you need to know the timing. Was the house provided for the whole year? According to the question, on 1st September, note number 4, he moved into his own house, isn't it? So the house was given for how long? So here we start of all first, we have furniture. For us to determine the taxable value for furniture, we say it is 1% per month, isn't it? Now he was in that house for how many months? So it will be 9% of 250. So that is the furniture. How much? Sorry? Ilikuwa 8 ama 9 or 8%, sorry. It is 8%, not 9, sorry. 1st September, that is 8. 8% of 250 ni ngapi? So hapo unaandika 20,000. And then he also given, the house had fixed telephone. Whose monthly bill was, so we have telephone here. Telephone, we said it is 30% of the bill. So it will be 30% of 6,000 times 8. Yeah. 30% of the bill to determine the taxable value for telephone if provided by the employer or being cleared by the employer. How much you get? 14,400. So the housing, to determine the house benefits, that is the last item. Why? Because it's based on 15% of the total gains from employment. So you must first of all list all the gains. Now you take 15% of that one for you to know the house benefits. So we need to exhaust all the employment benefits. We go to note number 4. Although we are not yet completely exhausted, note number 3. On 1st September 2010, he moved into his own house, which he had acquired through a 15 mortgage loan of 4.8 on 1st May. So that is a deduction item. So when you take a mortgage loan, after now you determine all the employment taxable benefits, you deduct. Okay? You deduct. I'm going to show you that one as we move on. Then number 5, he's a member of home ownership saving plan, where he had contributed 4,800 per month towards for. So that one is also a deduction item. It is an item that is used to reduce the taxable amount when you're contributing to a home ownership saving plan. We discuss these things, but you can as well review it. There's no issue. And then number 6, on 1st July 2020, he obtained a loan of 2.4 million from his employer at an interest rate of 7% per annum. During this period, the Revenue Authority prescribed interest rate was 12% per annum. So that is what we need to compute what we call fringe benefits tax. So that is it's a benefit that you as an employee, you're not taxed. So that one should not be among, after you've done everything, you can now compute it separately. So I'll show you, that is a benefit that you get from employment, but it's not taxed on you as an employee. We go to note number 7. He was out of his workstation in the month of August for 10 days on official duty. The company paid him an out-of-pocket allowance of 4,008. So we have out-of-pocket allowance. Out-of-pocket allowance. So 4,800. What did you say about this one? Anyone who can remember? Sorry? So you deduct 2,000 per, for the first 2,000 per day is tax exempt. And then you multiply by the number of days that he was out. How many days were they? 10 days. So the first 2,000 that you're given every day is exempted from tax. That is what we call a subsistence allowance when you are sent away from your normal working station to a different station that requires you to be there for a while. So the first 2,000 you're given as subsistence allowance is not taxed. Huh? 28,000. We go to note number 8. That one we already done it. Note number 9. The employer paid school fees for Alex Macali's children amounting to 148,000. This expense was not taxed on the employer. So school fees, we said it's either taxable or non-taxable, depending on how it is. If it is taxed on the employer, you are not taxed. If it's not taxed on the employer, you are taxed. So how do you know that it's taxed on the employer? The question can explicitly tell you, like this one they have told us, it was not taxed on the, so the employee will be taxed. Some other times they will tell you the employer treated it as an expense. If the employer pays your school fees as an employee or any of your dependents, and then he treats that school fees as an expense in his books of account, then it means it's not taxed. If the school fees is treated as an expense in the books of the employer, then it means the employer is not yet taxed, so you will be taxed. Another way to know that if we debit, to debit means to treat as an expense, isn't it? Yes. So now this one, you write your school fees. So school fees, it's either taxed on school fees, 148,000. So it will be taxed on him. Tumeelewana? Kweli? So we are through with note number 9. And then we go to note number 10. He is a member of a registered retirement pension scheme where he contributed 30,000 per month towards the scheme. The employer contributed a similar amount. So if the employer contributes on your behalf to a registered pension scheme, then that one is a non-taxable gain. In some other question, they will write you to comment on items not used. So that is the comment you make. You can comment, you say pension because you're not using it. Yeah, you say pension contribution by the employer, not taxable, isn't it? That is why you did not use it. And the one that you contribute as an employee, it qualifies as you to a deduction. Tumeelewana? So we have two kinds of pension: the one that you're contributing as an employee, and the one that is contributed on your behalf by the employer. The one that the employer contributes on your behalf, not taxable. And the condition is it must be a registered pension scheme. If it's not, then it is taxed. So we are through with that one, isn't it? Number 11, he has other incomes. So those incomes that are in number 11, they are not connected to employment. So you will first of all finish the employment income. When you have more than one source of income, you don't combine them together. Each and every source should be indicated separately. So here we are going to deal with employment first, finish up with employment. And then here I can see he has also investment income, that is dividend. He has also rental income, that is. So note number 11 relates to other incomes that are not employment. Remember, we said we have 5 sources of income that are taxed in Kenya. One is employment, another one is business, another one is investment, rental, and farming. So those 5. So you don't combine them together. You need, first of all, to finish up with employment. If the others and they have some income, you also now list them thereafter. Now that one will come back to it. Number 12, he secured a life insurance cover for his family of 8,000 per month with effect from 1st October 2020. So the insurance cover, is it paid for? Who is paying it? Who is paying the insurance cover? Huh? Yeah? The employee, isn't it? So that is not a benefit. The reason they told you that, so that you can remember, we have what we call insurance relief. If you're contributing to a life premium or educational premium, you're entitled to insurance relief of 15% of the premium, subject to 60,000. It should not go beyond 60,000. Either you are the one contributing or the employer is the one contributing for you. If the employer is contributing for you, it is a taxable benefit, and besides, you also qualifies to the relief. We have a relief of 15% of the total premium you are contributing to life premiums or educational premiums. So at this point, we have exhausted all the items from employment. But before, so we write here total gains, right here total gains from employment, total gains from employment before house benefits. Total gains from employment before house benefits. So we list them, we add them together. So 24,800. And then here we come and determine the house benefit. So we write here house benefit. I hope she's right. Is she right? Is this figure correct? It is correct. So we said for the house benefit, you take 15% of the total gains from employment, 24,800. Then you prorate. It was 8 out of 12. 8 out of 12. So 15%, the house was not given for the whole year. 80, not 800. So we delete 0 here. Oh, this one. This one is equal to 24,80. This one. So this is the house benefit. In the case, in the question, you've also been given the market rental value of the house you're given. You see the house you're given by your employer has its rates in the market. In some other question, you'll be given the rates. In other words, the amount of money that the employer is paying, isn't it? So if you've been given that, you compare with this 15% and then you pick the higher. So this one, you have not been given that one. So when you've not been given that one, you just take this one straight away. 15% of the total gains from employment. So this one we're going to write here, 24,80. There's no need for us to write here because there's no fair market rental value of the house that is given. And besides, if there is any contribution that you are making from your own ends, we call it nominal rent. If it is there, you deduct. If it is there, you. Now, the goodness of this question will always be there. It is question number 3C or B, always. At that point, you now less allowable deductions. Allowable deductions at that point. Then you underline here. So the first one is pension. So pension you compare with the actual contribution, the actual amount that he was contributing himself, not the employer. So he was contributing how much? 30,000 per month. So your actual contribution was 30,000 per month, and then you multiply by 12 so that you can be able to know the total amount for the whole year. How much will that be? Huh? So this one will be 360,000. So you compare with the set limit. Set limit, I told you it is how much? 240,000. And then 30% of the total gains from employment, which is 2480, 800 plus 2480. So you take 30% of the total gains from employment, or what we call pensionable pay. 30% of that. Sorry? 801. And then here you pick the lower. You pick the lower, which is 200. You subtract. Sawa. And then number 2, we had home ownership saving plan. We call it HOSP. Home ownership saving plan. You are saving to either construct your own house or buy it. So here we have the actual contribution he was making. That is in note number 5. He's a member of home ownership saving plan where he had contributed 4,800 per month towards the scheme up to 30/20. So in that year, he contributed how much? 4,800 times 4. Is it so? He contributed for 4 months only. Each month was 4,800. When you add the two, when you multiply the two, 19,200. And then there is the set limit is 48,000 per annum. So you divide by 12 to determine the monthly limitation, and then you multiply by 4. If it was the whole year, you'll have compared with the 48. So 16,000. Yeah. So you pick the lower of the two, which is 16. Tumeelewana? And then we have also mortgage interest. Mortgage interest. So we have the actual interest. The actual interest. So we go to note number 4. On 1st September 2020, he moved into his own house, which had acquired through a 15 mortgage loan of 4 point on 1st May. So when was the loan acquired? According to that readings, the loan was acquired on 1st May. So he acquired the loan on 1st May. Is it so? So the interest rate was 15%. This 15% is for the whole year times the loan amount, which is 4 million. And then now from May to 8/12. And then set limit here. Set limit is 300,000 per annum. So it's going to be 300,000. And then you divide by 12. And then you multiply by 8. So 300,000 is the total limit. And in other words, you should not deduct the interest beyond 300,000 in a year. So we want to know to prorate. It should be in accordance to the loan time, the period for the loan. So how much will this one be? The first one? Eh? 400,000, the first one. So this is 400,000. And the second one, 200. And then we pick the lower. We pick the lower. So those are the deductions from employment. And then here you get the total taxable employment income. Total taxable employment income. So we can add this, and you deduct this, get the total taxable employment income. Total taxable employment income. Kama uelewi unauliza, unajua hii tax hakunaga mtu anaanguka hii shule. So ukianguka utakuwa mtu wa kwanza. This is the only unit that everybody anapitaka. You will be the first one. Because why will you know this one? You know this one will come in exams. Sasa hii ndio unit unako exam ukijua hii ndio inakuja. Sasa utaanguka aje shwali. Inakuja ngapi? Huh? 22 sorry. Okay, 11 for 8 11 for at 220. 11 to 80. So that is the total taxable employment income. Then if the other incomes now, you come and deal with other incomes now later on like this. You write the other incomes. So we go to the other incomes, note number 11. Note number 11. So he received dividend from only cooperative net of tax. So we say dividends are subdivided into 3 categories for the purposes of tax. Category number 1 is dividend from, we call them qualifying dividends. These are dividends from companies, both public and private, and dividends from SACCOs. If you receive dividends from those 2 institutions, you pay a withholding tax of 5% that is the final. So when these 2 institutions, either companies or SACCOs, pay you dividend, they will deduct 5% of the total dividend. And then they give you the amount net of tax. That one will be the final tax you pay. There's no any other extra tax you pay. So in other words, if you see dividend from maybe Wajuzi SACCO or Baroda Limited. So that one you just write it there, withholding tax final. But this kind of dividend that is indicated here is what we call non-qualifying. Non-qualifying dividend is the dividend received from cooperative societies other than SACCOs. What is the difference? What is the difference? Even this one, there's no, the naming itself. There's no word SACCO. The other one, lazima ikuwe na savings and cooperative society. Na hii haina hiyo, si ndio? So this amount that is indicated here, so you write here dividend. So the gross amount must be added again to the other incomes and subjected to the graduated scale rate of tax. So this amount that is indicated there, you see they have told you net of tax. This one attracts a withholding tax of 15%, which is not final. So this amount that is indicated, 85,000, is equivalent to 85%. So you determine the gross amount. What is 100%? So it will be, you cross multiply. So it's going to be 100 over 85 times 85,000. It attracts a withholding tax of 15. 100 minus 15, it is 85, isn't it? So this you see they're telling you net of tax. So they expect you to know that it attracts a withholding tax of how much? 15. So this amount is equivalent to 85% because they have chopped off 15%. You need to determine the gross. Gross now you compare with 100. Nakuja ngapi? 100,000. So you add here 100,000. So we go to the rental income. So rental income, we said we have 2 categories of rental income. We have residential rental income and commercial rental income. So we said for residential rental income, the gross income that you get from the residential properties that you have, 10% is the final withholding tax of 10%. You have housing units that you let out for residential purposes. And then you get income from those housing units. So the income can either be on monthly basis, quarterly basis, whatever period you get them. If you get them on quarterly basis, you pay 10% withholding tax. That is for residential rental income, isn't it? And then we have commercial rental properties. This one, as long as the income is less than 10 million, as long as the income is less than, you also treat them the way you treat residential income. So you come here, write rental income. you write here withholding tax final because it is less than 10 million. You write there dash. Tumeelewana? Unaweza kuwa na nyumba kategori mbili. Zile nyumba unakodisha kwa watu kuishi, si ndio? Na kuna zile nyumba kama building ya commercial ya biashara. So hii building kama haileti more than 10 million, unaichapa 10% ya hiyo pesa, unapatia KRA. Kama inaleta more than 10 million, una less allowable deduction. Nilikulistia allowable deductions za nyumba pale kwa hiyo handout. Unaziless, alafu sasa kama ni individual, you subject to what we call the graduated scale rate of tax. If it is a company, you tax it use corporate tax rate of 30%. We are through with the note. So at this point, we are through with everything called, we write here total taxable income. Total taxable income. Now it becomes total taxable income. That is employment plus other income. 23, 11 to 80. Tunaelewana? We go now with tax. That is, you come here and write clearly Roman number 2, tax liability. Tax liability. So we use the latest graduated scale rate of tax. So unaangalia kwa hiyo pass paper yako. So the latest one. So the latest one, I don't know whether you can be able to see it. The first schedule there, we have a table, the first page of your question papers. So you take the total taxable income, which is 23, 11 to 80. And then here you write the rate and here the tax. So they are saying from the total taxable income, you first of all, the first 288,000, the first 288,000 from your total taxable income, you only tax at 10%. So this one will be 28,800. The first 288,000 from the total taxable income, you only take 10%. Any amount above that one, not yet taxed. So you take this one, the difference. What do you get? $20, 23 to 80. Sindio? And then the next 100,000, that is the difference between 388 and 288. So in other words, if your salary or your income is above 288, you again qualify, you be taxed to the next level. If you go to the next level, which is 25%, and that is they only take 100,000 from the remaining tax amount. How am I getting the 100,000? You take the difference between 388 and 288. Unaangalia schedule. 388 minus 288, the latest one. We are using the latest one. Okay? Latest one iko kwa hiyo question paper nimetuma. Ukiangalia swali ya April 2022 kuanzia hapo iko hiyo. Nani hajaona? Umeona? The latest one. So the hapa ni in the first, the next 100,000. This one you tax at 25%, isn't it? So this one will be 25,000. So you deduct 100,000 from this one. What do you get? 202, 320, 80 minus 100,000. 19, 203, 280. 19, 23, 280. Sindio? And then the remaining amount after that one, you tax at 30. So the entire amount that is remaining, you tax at 30%. So that one will be how much? 576, 944. Like that. So now you add all of them, you get what you call gross tax payable. Gross tax payable. You get what you call gross tax payable. 630, 630, 637, like this. 637. And then you less now what we call you less pay. You less pay as you want. Pay was how much? 19,600 times 12. How much is that? $235. And then you also less personal relief. You less personal? Where do you get the personal relief? It is there given. The current rate is 28,800. Yeah. So you less that one, 28,800. And then you also less the withheld tax, the holding tax. This 15% of 100, that one was withheld. In other words, you paid in advance. 15% of 100 is you less 15,000. And then you less insurance relief. You less insurance relief. So he was paying 8,000, note number 12. So it is 15% of 8,000 times 3. But remember, this amount should not go beyond 60. If it is beyond 60, you take 60,000. So 15% of it, this one is over how much? So 3,600. So you'll get the net tax payable or refundable. Net tax payable stroke. So you get the net tax payable or refundable. Net tax payable or refundable. Tumeelewana? Swali? Net tax payable or refundable. So now you take this amount, you deduct this one. And then you're going to compute what we call the fringe benefits. This one now you compute outside everything. This one was in note number 6. On 1st July, he obtained a loan of 2. So fringe benefit, we said, is the amount of loan. And then here we have prescribed rates, interest rate, minus the low rates. That is what we said. So the amount of loan that was given by the employer was how much? 2,400,000. So the prescribed rate by the revenue authority was 12%. And the employer gave out at, and then you multiply by, is it 6 out of 12? Because the loan was not given for the whole year. Nakuja ngapi? Just 12 minus 7 times 2.4, eh? Are you sure? 500? Up and 500,000. It looks huge, eh? 60? So 60,000. You don't convert this one to percentage again. Just subtract 12 times minus 7. And then you multiply by 2.4. You also multiply by 0.5. Do you get this value? And then here you come here and compute fringe benefit tax, which is 30% times fringe benefit times, now this one will be 1 over 6 because it's 6 months. So it's going to be 30% of 60,000. And then it is paid on monthly basis. So 1 over 6. So the employer is going to be paying 3,000 fringe benefits. So if this one is there in the question where you're given a loan at a low interest rate, it is not a taxable benefit, but you just come and show it away from your working. So that is how we handle this question. That is how we handle that question. Any question? So I can give you a few minutes to either you want to copy or to take a photo of it so that we can do another one. The second one you can copy. So what do you want to do, to take a photo or copy? So you can do it very fast. Have a look at another question in the same regard. Another question, we can look at it. So that is November 2019, question number 3B. 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 November 2019, CPA, November 2019, question number 3B. So the question reads, Suan Compo is employed as a managing director of the Utamu Distributors, a tax-exempt company. During the year ended 30th December 2018, he presented the following information. Number one, his basic salary was 120,000 per month, pay 48,000 per month. And number two, he was provided with lunch by the employer from 1st August 2018 of 4,800 per month. Number three, he was provided with a fully furnished house fitted with water and electricity. The employer paid a monthly rent of 45,000. He was deducted 10% of his basic monthly salary for rent. The cost of furniture was 300,000 shillings, while the monthly electricity and water bills was 3,500 shillings and 2,800 shillings, respectively. Number four, the company paid for him life insurance premium of 6,000 shillings per month for each member of his household from 1st September 2018. He had included himself, his wife, and their son in the insurance policy. Number five, he contributed 10% of his monthly pay towards a registered pension scheme, while the employer contributed 15% of his basic salary towards the same scheme. Number six, he enjoyed free medical treatment under a medical scheme operated by the company for all employees. His medical expenses were assessed at 150,000 shillings during the year. And number seven, during the year, the company paid a total of 35,000 shillings as school fees for his son studying in a county school. This amount was not included in the company's income statement during the year. Number eight, on 1st August 2018, the company provided him with the following: a Land Rover, which was acquired at a cost of 1.8 million with an engine capacity of 3,000 cc, a gardener and a night watchman whose monthly salary was 12,000 shillings, 12,500 shillings and 15,000 shillings, respectively. And number nine, he invested in real estate and earned a net rental income of 72,000 shillings after deducting the following expenditures: caretaker's wages, 120,000, fencing, 40,000, loan repayment, 320,000, insurance, rent and rates, 48,000, petitions, 60,000, capital allowances, 22,000, gross rental withholding tax paid, 68,200. Number 10, he received a net dividend of 42,500 shillings from Maziwa Cooperative Society Limited, during the year. So required Roman 1, total taxable income for Suan Compo for the year ended at 1st December 2018, 10 marks in bracket. Roman 2, taxable tax payable in bracket, if any, from the income computed in B Roman 1 above, 3 marks. Comment on any information not used in your computation under B1 above, 2 marks. Total marks 15. So one thing to note from the question is that the entity that this man is working for is tax exempt. So you and the entity are two different persons, isn't it? So if your entity you're working for is exempted from tax, it doesn't mean that you are also exempted, isn't it? It is the entity that is exempted. So you are two separate personalities as far as tax is concerned, isn't it? So he will be taxed. So we write the name here, Mr. Suan Compo. Suan Compo, computation of taxable income, computation of taxable income for the year ended for the year ended 31st December 2018. For the year ended 20. So now for online students, in case you don't have past papers and or information, you need to specify which one you need because you're handling so many students, different topics, so different units. So you specify I need this and this. So we start here writing, we list the gains you're getting from employment. So we have the basic salary. The first one that we have the basic salary. The basic salary, how much is it? So you write here shillings. So he's getting a basic salary of 120,000 per month, and then you multiply by 12. So it, so here right here 1440,000. That is the first item. We are through the note number one. We go to note number two. It was provided with lunch by the employer from 1st August 2018 of 48,800 per month. So 4,800, isn't it? Will lunch, what did we say about lunch? Anyone who can remember? You're given lunch by your employer. We said, 4,800 per month. Sorry? Anyone who can remember? The first 2,000. Are you sure? So now lunch, we said it's lunch. We said is it 48,000 per? Is it 48,000 per annum, isn't it? When you divide by 12, what do you get? 48, 2,000, 4,000, isn't it? So we're saying if the amount is okay, if the amount is okay, we can treat it as a facility. You remember facility? We say it's provided is 3,000 and above, which was 36. Was it 36,000 per annum? If the amount is more than 3,600 in any given period, you tax. You tax. So here is lunch. So it is 4,800 times from August to December. How many months are those? Is it 4? 5. How much will that be? 24,000. And number 3, he was provided with a fully furnished house fitted with water and electricity. The employer paid a monthly rent of 45,000. He was deducted 10% of his basic month salary for rent. The cost of furniture was, so we have furniture here. So we have furniture. So the only thing you are keen on when it comes to housing and furniture, was it given for the whole year? In this one, was it given for the whole year? What was the period? It was for the whole year, isn't it? So it is 12% of 300,000. Furniture 12% of 300,000. 36,000. And then also besides housing, there was also another one called. So he was given water. So water, there is the actual bill that was paid for the water. So the cost of furniture was 300,000, while the monthly electricity and water bills was, so 2,800, isn't it? Times 12. And then there is a prescribed amount. Prescribed amount, this one you are given in the question. So 2,800 times 12 is how much? 33,600. 33. Prescribed amount, you check the first page of your question papers. Mine is showing, if it is annual, you're given water, monthly rates is 500. Annual rates is 6,000. So you write here 6,000. You pick the higher of the two, which is 33. So you write that this one is the one that's going to be taxed. Then we have electricity. Electricity, we have the actual bill. Well, how much was the electricity per month? 3,500, isn't it? Times 12, 42, 42,000. Prescribed amount, 18,000. You pick the higher of the two, which is 42,000, isn't it? We have agreed that the housing is computed the last, isn't it? Reason being, it is based on 15% of the total gains from employment. So you go to note number 4. Note number 4. The company paid for him life insurance premium of 6,000 per month for each member of his household. So the company paid for him. So this one is insurance premium. That is a benefit to him. Insurance premium. So he paid how much? 6,000 per month. 6,000 per month for how many persons? Is it 3? 3 persons, isn't it? His son, wife, and himself. And then for how long? From September, isn't it? So for 4 months, you multiply by 4. So this is the amount of insurance that was being paid for 3 persons and for 4 months. 70. So this is a benefit. It is a benefit to him. It is the employer contributing. Okay. We go to number 5. He contributed 10% of his monthly pay towards a registered pension scheme, while the employer contributed 15% of his basic pay towards the same scheme. So there's that pension scheme that is contributed by the employer, we said, non-taxable. The one that you contribute, allowable deduction, isn't it? Ile one contribute allowable, so long as it's a registered pension scheme. Remember number 5. We go to number 6. He enjoyed free medical treatment under a medical scheme operated by the company for all employees. His medical expenses were assessed at 150,000 during the year. So we said if there is a medical scheme that is being run by your employer, which is covering all the employees, it's not discriminating, then that one will be non-taxable gain. If it is discriminating, it is taxable. How do you know that it is discriminating? They will tell you that only a particular section of employees are covered, isn't it? If it only covers only a portion or a section of employees, maybe senior managers only, then that one will be taxed. But this way, the one that covers all the employees, that one is not taxed, like this one. We go to note number 7. During the year, the company paid a total of 35,000 shillings as school fees for his son studying in a county school. This amount was not included in the company's income statement during the year. So it means it was taxed on the car. So long as the company has not treated that one as an expense in their books, it means it is taxed on the company. Are you together? So that one is not taxable. So you can leave it. And then we go to note number 8. On 1st August 2018, the company provided him with the following: a Land Rover, which was acquired at a cost of 1.8 million, with an engine capacity of 3,000 cc. So this, we have car benefit here. So we write here car benefit. So we have the CC ratings. For Land Rover and Land Cruiser, you go the last item in respect of the CC ratings. You go to the last item under the car category, the last column of that particular schedule. So you have the Land Cruiser. Land Cruiser is 7,200 per month. 7,200 per month. It was given on 1st August. So how many months to the end of the year? 5 months. So 7,200 per month, and then you multiply by 5 for that period. 6,000. So this one will be 36,000. Then you compare with the 2% per month. So 2% times 5, that is 10%, isn't it? It is for 5 months. And then with initial, you multiply by initial cost of the vehicle, which was 1,800,000. So you take the higher of the two. When you take 10%, what do you get? 148. 180,000. And then here you pick the higher, which is 180,000. So you write there 180. So that is how we determine the car benefit. Note number 8 also has other benefit, a gardener. So there was also a gardener and night watchman whose monthly salary. So we said if there's a servant who works for you and the salary is paid for by the employer, that is a benefit that is taxed on you, and the benefit is the amount of salary that is given to the servant. Tumeelewana? So gardener inakuja ngapi? $12,500 times 5. And then night watchman. $15,000 times 5. The first one is? Second one. The first one, 62,500. Yaani wewe umepewa huyu anakufanyia kazi kama unafanyiwa kazi, si ndio? Na huyu mshahara wake wewe ulipi. Employer wako ndo analipa hiyo mshahara. So hiyo ni benefit kwako. Wewe utachapwa ushuru kwa hiyo. Sawa? So that is how it is done. And then we go to note number 9. He invested in a real estate and done a net rental income of 72,000 after deducting the following. So that one you only check. That one is other incomes that is not related to employment. So we're going to deal with it later on. Then number 10 also is not employment income. So at that point, all the employment details are exhausted. So you get your total gains from employment. Total gains from employment before house benefit. So what do you get? Total gains from employment before house benefit. Total gains from employment before house benefit. Sorry? 1965. And then here we come here and compute the house benefit. House benefit. I think we can use this space. So we come here and compute the house benefit. House benefit. House benefit is 15% of the total gains from employment, which is 1965, 100. So what do you get? 94. 294,765. And then you compare with the market rent of value. Market rent of value. Market value. Okay, market value. Can you just write your market value? So the market value was how much? 45,000 per month. Is it so? So the house, the value is 45,000. You multiply by 12. So what do you get? 540. So this is 540,000. So here you pick the higher of the two, and then you less nominal rent. You less nominal rent. So nominal rent, he was deduct 10% of his basic. So 10% of his basic salary of 1440,000. That is 144. So you deduct after you pick the higher of the two, which is 5. Then you deduct 144,000. How much do you get? 386. So that one will be the housing. So then we less allowable deduction. We less allowable deductions. So we have pension. So we have actual pension, which was 15%. Was it so? He contributed 10%, it was a registered pension. 10%, it was 10% of 1440. Yes. We pick the highest. This is 294,765. This is 540. Which is the highest? This is 294,765. This is 540. Which is the highest? And then that is what you pick. Then you deduct 144. Is that what you did? Yeah, that is what you pick. We pick the highest of the, you compare the 15% of the total gains from employment, then you compare that value with the market rental value of the house. Whichever is high of the two is what you pick. And in case there is any nominal rent, you deduct. We have discussed. I hope you know what is nominal rent, isn't it? So now we are at pension. So he was contributing 10% of his basic salary to a pension scheme, which is 144,000. This is a contribution. And then we have the set limit. Set limit, we said it is 240,000. And then we have the 30% of the pensionable pay. 30% of the pensionable pay. $1,965, 100 plus 396, and then 0.3. How much? 708. And then you pick the lower, which is 144,000. You pick the lower. We don't have any other item at that point. And then you get the total taxable employment income. Total taxable employment. Total taxable employment. Total taxable employment income. So can we add this plus this minus this? Yes. Si nyumba pia amepewa nyumba. Si nyumba ni benefit. Pension umepei inakuwa hizi gain zote plus nyumba. Si nyumba pia amepewa. Ama? Yes. So this one is a combination of all the gains is receiving from employment, isn't it? So napita ngapi? 217. Hivyo. And then you add other incomes. You add other income. So he had other incomes. He had rental income. But we said rental income provided that the income is less than 10 million, isn't it? So rental income, withholding tax, final. I hope you notice withholding tax. Withholding tax is the tax that you pay at the source of the income, isn't it? Like if you're employed, your employer deducts, it gives you a pay less of tax, isn't it? That is a good example of withholding tax. So he withholds the tax. And then we have dividend. Dividend net, isn't it? So that's going to be 100 over 85 times 42,500. Unapata ngapi? Eh? 50,000. Then you get the total taxable income. Total taxable income. Total taxable income. So you add this one plus 50. Sorry? 2267. Eh? 100. And then here, Roman number 2, you compute what we call the tax liability. So you take the total income here, which is 22. Okay, let us do it here so that you can be able to see, isn't it? Tax liability, you take the income, 22, 67, 100. Then we have the rate, and then we have the tax. 22, 67, 100. We have the rate, and then we have the tax. So we say the first 2288,000, we are using the current scale. We tax at, which is 28. Any amount excess of that one is not a tax. So what will be the next amount? Eh? Eh? 1979,000. 1979,100. And then the next, this is the first, then the next 100, the next 100,000 at, which is 25. Any amount that is excess, you know, 1879 at 30. $563, 17. 563, 730. Then you get here what you call the gross tax payable. Gross tax payable, how much is it going to be? 617, 530. Then you less pay. How much is the pay? 48,000 per month. And then you multiply by 12. We're happy? 576,000. And then you less personal relief. Personal relief is 28,800. Then you less insurance relief. Insurance is going happy? 72. 15% of 72,000. Are you happy? Eh? 10,800. And then we have withholding tax. Withholding tax, which is 15% of 50,000. 15% of 50,000 is how much? 15% of 50,000? 7. So you less here 7,500. So you get the net tax payable stroke refundable. So that is how we do those questions. I think at that point it is good that you attempt one. Anything that is not clear, I thought I would clarify. Anything that is not clear? Sorry? So you see, you take 15% of the total premiums you are paying. Total? 15% of the total premiums. Yeah. No, not 60,000. If that 15% of whatever you are paying is more than 60, it's more than, it should not go beyond 60. Sasa unafanya hivi, unachukua 15%, unaona hapa, of 72,000. Imekuja ngapi? 10,800, ndio? Hapo una set limit. Set 60,000. Unachukua the lower of the two. The lower of, umeelewa? Hii ikipita 60 unachukua nini? 60. Kama haijapita 60 unachukua hiyo. Tumeelewana? Kazi rahisi sana. Ile kitu unajua rahisi sana hii dunia ni nini? Ni hii sasa, kama hujui kitu yote rahisi hii dunia. Sasa hii ndio nimekupatia kitu rahisi. So now assignment. Assignment. It is good to do assignments. There is a difference between wisdom and knowledge. There's a difference between wisdom and a knowledgeable person knows something. If you're knowledgeable, it means you are aware. You are aware that this thing is supposed to be done. And when you are wise, you do it. For example, it's good to do, good to do assignment and you have it checked. You know that one. If you don't do it, then you are foolish. So that is the difference between wisdom and knowledge. You're not born with wisdom. You are quiet on the earth here. So wisdom is knowledge applied. So assignment May 2021, question number 3B. 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 That is assignment. And then you can also do November 2018. Is it November 2018? Let me see. So May 2018, question number 3C. May 2018, question number 3C. In November 2017, question number 3B. November 2017, question number 3B. So if you're online, you submit it, you scan and submit it to my line, this one. If you're physical, make sure you do it and then you present it. Sawa sawa. So now that is the end of our class today, unless there is a question.